Good afternoon, everybody. Welcome back to Trades and Gains. I'm your host, Max Pitts, and this is the only place where we explain the stock market without pretending this all makes sense. It's the midday already, and stocks are doing what they do when they look calm, but under the surface, they are just emotionally unstable. AI is everywhere. Robots are now driving cars. Vacuum cleaners are filing for bankruptcy somehow. And the Fed is once again telling us everything is quote unquote gradual, which in Fed language basically means please stop asking us questions so Donald Trump can go ahead and insert his new mouthpiece. Today's market story is, well, it's simple. The future is arriving faster than expected, and not everyone survives the upgrade, unfortunately. It's like being an old iPhone. Some companies are getting $1 trillion valuations for promising AI dreams, and others are getting Chapter 11 for, well, selling Roombas. So let's go ahead, make like some butt cheeks, and dive straight into the matters of today. And, well, find out what Wall Street is quietly repricing. So, to kick things off, let's talk about everybody's favorite and most controversial electric vehicle manufacturer, Tesla. Tesla robotaxis are now testing in Austin. And yes, there is no safety driver in these. There's no human, there's no babysitter, just code and blind confidence. Elon Musk went ahead and confirmed it. Tesla's head of AI replied, and so it begins. So this means A, the beginning of a $1 trillion autonomy business, or B, the first line of future congressional hearings. Tesla stock popped nearly 4% on the news, creeping back toward all-time highs. And this is the key point. Not because of earnings, not because of margins, but because the market, well, it finally believes autonomy isn't this theoretical thing anymore. It's real. It's in the streets. It's potentially mowing down your children. And this is where Tesla stops trading like a car company and starts trading like an AI platform with wheels. Wedbush's Dan Ives says 2026 is the monster year. We have Robotaxi scale, we have cybercabs hitting volume production, we have autonomous plus robotics defining Tesla's future more so than a Model S or a Model 3. And look, listen, you don't have to believe every Elon promise to understand why the market cares. Because if Tesla cracks autonomy first, really cracks it, you're not valuing cars anymore. You're valuing transportation as a service, logistics, urban mobility, and yes, an AI subscription model on wheels. Is it risky? You bet your butt it is. Is it early? Yeah, probably. Is the market willing to pay up anyways? Yeah, you bet your margin account it absolutely is. Now, speaking of robots, not everything is happy in autonomy world because this iRobot is an example when robotics goes extinct. iRobot. Yes, these are the same people who make the Roomba. They filed for bankruptcy. The stock's down over 70% today. And this is what happens when you invent consumer robotics, you lose your pricing power, you get crushed by cheaper competition, you eat tariffs and don't really adjust, and you borrow money assuming Amazon is going to eventually save you. Spoiler alert, Amazon did not save them. The irony is absolutely painful. Tesla builds robots that drive cars and gets rewarded with a rally. iRobot builds robots that clean floors and it gets sent to the gulag or the shadow realm. This isn't just about execution, it's about where value lives now. The market doesn't care about gadgets, hardware alone, or quote unquote being early. It cares about platforms, data, AI leverage, and, well, recurring value. iRobot didn't fall or fail because robots aren't the future. They failed because, well, they were the wrong kind of robot. People don't want that. Speaking of robots and AI, OpenAI is the company of the year and everyone's credit is at risk. So let's talk about the gravitational center of the markets in 2025. We have OpenAI. Yahoo Finance named it Company of the Year, and honestly, it's fair. 800 million weekly users, 13 billion in revenue, and a $500 billion valuation, and over 1.4 trillion in spending commitments. That's not a startup, that's a nationwide state with a GPU addiction. But here's where the markets are starting to sweat. OpenAI is spending money like it's basically allergic to cash. Hundreds of billions to Oracle's, hundreds more to Microsoft, massive chip commitments to Nvidia, AMD, and Broadcom. And there's, well, data centers everywhere. And guess what? Investors are finally asking the uncomfortable question. At what point does AI growth become an AI balance sheet problem? This is why you're seeing pressure in Oracle, Broadcom, CoreWeave, and even parts of the chip complex. Not because AI is dead, but because someone has to pay for it at the end of the day. And when one company becomes half your backlog, that's no longer diversification. That's just called a codependent relationship. The market is transitioning from AI as the future to who actually gets paid without blowing up their balance sheet at the end of each quarter. And speaking of balance sheets, Nvidia is winning by, well, owning plumbing. They just acquired ShedMD, the company behind Slurm, the software that schedules massive AI workloads across data centers. This isn't flashy, and no, this isn't hype. This is an infrastructure dominance play. Nvidia isn't selling chips anymore. They're selling hardware, software, open source tools, and developer lock-in without calling it, well, lock-in. While everyone argues about AI bubbles, Jensen Huang is out here buying the plumbing that makes the whole thing run. This is how you survive when competition heats up. You become basically indispensable. Now, finally, we have the Fed. It's modestly restrictive, is Fed speak for, well, don't panic. The New York Fed president, John Williams, says rates are, quote unquote, modestly restrictive. We're getting closer to neutral. The economy should pick up steam in 2026. Inflation risks, well, they're fading, and job markets are starting to cool, not collapse. For those of you who just want it in plain English, the Fed thinks it pulled this off. They think they avoided a recession, and they're positioning for gradual easing. But here's the key word: gradual. Not fast, not aggressive, not save the market at all costs. This is the Fed saying, we'll cut, but don't get cute and don't get comfortable. And the market hears that and says, perfect. That's all we needed. This is why equities stay bid. This is why risk appetite survives. And this is why volatility refuses to die. Because while everyone's trading the future while pretending the present is currently stable when we're probably not in a great economy. So let's go ahead, make like a condom, and give you your midday reality check. Tesla, it's proving autonomy isn't a demo anymore. Old robotics, well, they're getting wiped out at this point. And AI still dominant, but the balance sheets are starting to actually matter. Nvidia, well, it's tightening its grip on the AI sector quietly. And the Fed, it's signaling we're not done, but relax, don't get too happy. This market, well, it's not about hype anymore. It's about who can execute without blowing themselves up. The winners aren't the loudest. They're the ones who control infrastructure, data, and cash flow. But don't worry, if you stick with trades and gains, if the Fed blinks, Tesla flies, or another robot dies before the close, you know where to find us. Go ahead, leave a comment, subscribe so you never miss a daily update. Go ahead, hit that bell notification so you never miss another video. And I'll see you guys in the next one. I hope you're having a great trading day. We're currently hanging out on Twitch, trading futures and indexes and trying to find some interesting swings from, by the way, Investor Central Club. One of the best options flow, if not the best options flow software in the market right now. hope you guys have a great rest of your day. I'll see you in the next video.